Dear viewers, welcome to our channel GVS Bank Academy. Today I am going to discuss retail banking and wealth management, 4 case studies from the previous examinations. JAIIB, this is for new paper, retail banking and health management. This is earlier it is there in CAIIB, now they are shifted to JAIIB. Now we are providing coaching for JAIIB classes for October 2023 examinations starting from first week of June 2023. Presently revision classes for JAIIB June 2023 is going on. Interested members are requested to contact on this mobile number. Case studies. First case study, RBI deregulation of savings bank deposit interest rate, RBI guidelines dated 25/10/2021. So earlier savings bank rate of interest is regulated by RBI with effective from 25/10/2011. It was deregulated. It means banks internally, banks are free to determine their savings bank deposit interest rate subject to the following two conditions. First, each bank will have to offer a uniform interest rate. Each bank will have to offer a uniform interest rate on savings bank deposit balance up to 1 lakh rupees. Savings account balance up to 1 lakh, uniform rate of interest, irrespective of the amount in the account within the 1 lakh limit, uniform for all the customers. Number 1. A. B. Second, for savings bank deposit over 1 lakh, balance, bank may provide differential rates of interest. Bank may provide differential rate of interest if it so chooses, if it decides, if it wants, subject to the condition that banks will not discriminate in the matter interest paid on such deposits, and they cannot discriminate one deposit to another similar amount accepted on the same date at any of its objects. Means the differential rate of interest also similar amount accepted on the same day, same amount. So this is the over 1 lakh deposit, banks are having differential rate of interest. General condition. Nowadays most of the banks are normally paying interest on savings bank deposit at quarterly intervals, that is March 31st, June 30th, September 30th and December 31st on daily product basis. They are calculating on daily product but interest creating on monthly basis, quarterly basis. Second case study, entry of banks into insurance business. Entry of banks into insurance business. RBI notification dated 15/1/2015. Bank want to set up a subsidiary or a joint venture for undertaking insurance business with risk participation in the insurance business. Either subsidiary or joint venture. Conditions. First condition, the net worth of the bank should not be less than 1000 crores. Net worth of the bank should not be less than 1000 crores. Second condition, capital to risk weighted assets, CRAR, capital to risk weighted ratio of the bank should not be less than 10%. So CRAR not less than 10%. Third one, the level of net non-performing assets should not be more than 3%. Net non-performing assets not more than 3. Net non-performing assets means gross NPA minus provisions. Net non-performing should not be more than 3%. Fourth condition, the bank should have made a net profit for the last 3 continuous years. Means prior to the starting of the business, last 3 years continuously profit making. Net profit for the last 3 continuous years. Fourth condition. Fifth one, the track record of the performance of these subsidiaries. If the bank is having any other subsidiaries, the track record, if any, concerned bank should be satisfactory. It means any bank is going for insurance business, and if the bank is having any other subsidiaries, the performance must be satisfactory. Means profit making and other satisfactory. Fifth one. Sixth one, RBI approval would factor in regulatory and supervisory comfort on various aspects of the bank's functioning, such as the bank corporate governance, the bank risk management must be transparent, it must be clear. So at the time of considering regulatory and supervisory comfort, will say through corporate governance and risk management. This question also they are asking several times as 2 marks case study or 4 marks case study or 5 marks case study in retail banking. Earlier CAIIB examination, so now it is shifted to JAIB. Case studies number 3, PMVBY, Pradhana Mantri Vayu Vandan Yojana, pension scheme, Pradhana Mantri Vayu Vandan Yojana. What is this? 11 points are there. 5 marks case study they are asking. What is there? Minimum entry age to join in this scheme is 60 years completed, senior citizens. Maximum entry age no limit. Minimum 60 years senior citizen complete and maximum no age limit. Policy term 10 years and investment limit maximum 15 lakhs for senior citizen. Minimum 1.5 lakhs, maximum 15 lakhs. This is pension scheme of Government of India for senior citizens. Implemented through LIC of India. Implemented through LIC of India. Amount to be deposited is minimum 1.5 lakhs and maximum 15 lakhs. Minimum 1.5, maximum 15 lakhs. Pension per month, guaranteed minimum pension 1000 rupees per month, maximum 12,000 rupees. If they are investing 15 lakh, they will get 12,000. It provides assured return 8% per annum. Quarterly, monthly equivalent to 8 for 10 years. Exempted for GST. Exempted for GST. Loan up to 75% of purchase price the investor will get. Premature exit is allowed for the treatment of critical illness of self or spouse. 98% of the purchase price shall be refunded. It means 2% discount. Premature exit is also allowed for critical illness of self spouse. On death of the pensioner during the policy of 10 years, during the 10 years period, death of the pensioner, purchase price shall be paid to beneficiary. Purchase price shall be paid to beneficiary. So these are the conditions for PMVB, Pradhana Mantri Vayu Vandana Yojana scheme. This is there. 5 marks question, 2 marks, 4 marks or 5 marks questions they are asking on this. This is case study number 3. Case study number 4, RBI Master Direction on Securitization of Standard Assets 2021. These are new guidelines. Several examinations they are asking this question. Obligor means borrower. Originator, banks or financial institutions. Third, originators, banks shall sell asset to special purpose entity or special purpose vehicle only on cash basis. Transfer subject to only on cash basis, and the amount of sale consideration should be received not later than transfer of the asset. So before transfer, entire sale consideration they have to receive in the cash basis only, no bonds. Third point. Fourth point, minimum retention requirement, MRR. Minimum retention requirement for underlying loans with original maturity of 24 months or less. Loans with original maturity, original tenure of 24 months or less, the minimum retention ratio shall be at least 5% of the book value of the loans being secured. What are the loans being secured? Minimum 5% they have to retain if the original maturity is 24 months or less. for underlying loans with original maturity of more than 24 months, as well as loans with bullet payment. Loans with 24 months, loans with bullet payment, minimum retention requirement is 10% of the book value. More than 24 months plus bullet prepayment loans, minimum retention is 10% of the book value. In case of transfer of the securitization assets, mortgage backed securities or mortgage loans, residential mortgage loans, the minimum retention ratio for the originator, means banks, minimum retention shall be 5% of the book value of the residential mortgage backed securities, irrespective of the original maturity. 5% they have to retain. That is the 6th point. 7th, limit on total retained exposure by originators. Limit, overall limit on total retained exposure by originators, means banks. The total exposure of an originator to the securitization exposure. And means, what is the total exposure under the securitization exposure belonging to a particular structure, in particular loan structure, particular scheme, should not exceed 20% of the total security exposure created by such a structure or scheme. It means a particular loan, particular portfolio, securitization structure or scheme should not be more than 20% of the total securitization exposure, means total sale or securitization of standard assets created by such a structure, means such a securitization structure or scheme. These questions they are asking, what is the minimum retention period? If the loan maturity 24 months or less, 5% of the book value of the loan securitization. It is more than 24 months, bullet repayment 10%. If these loans are belong to mortgage backed securities, 5% book value irrespective of the original maturity. The 3, 4, 5, 6 points are important. Thank you very much, viewers, for extending support to our YouTube channel. Thank you very much.